All right, guys, welcome back. So we've so far covered steps 1 and 2 of the process. We're now going to look at step 5. So we're going to close off the recognition section before moving on to steps 3 and 4 to speak to measurement. Okay. I think step 5 is the easier of the recognition steps. Okay, but of course you can tell me if I'm wrong. But step 5 is essentially the last step in the revenue process, and we are saying, okay, now we've worked through everything. We know what the POs are. We now need to assess how do we satisfy these POs. In other words, how do we transfer control? So remember I said part of what the standard tries to assess is, or the standard's assumption is that in any contract between entity and customer, there's a transfer of control of goods or services. Step 5 is to say, when does this control happen? Does it happen over time, so continuously over a period, or does it happen at a specific point in time? Okay. Step 5 really brings into effect, or kind of shows you why they think the standard can be applied to a number of different sectors. That's the reason why we've got different criteria of how and when revenue should be recognized based on the considerations for different sectors. With step 5, revenue is recognized either over time or at a point in time. Key is we always start with assessing over time. First consideration is it recognized over time? And how do we assess this? We assess if it's over time, if it meets any of these. So it's either this or this or this. If none of these are true for that particular PO, then that means that PO was satisfied at a point in time. So we first consider, is this particular PO at a point, over time? If no, if none of these are applicable to the entity or to this particular PO, then it's at a point in time. Okay, so first over time assessment, then point in time assessment. So what are the three things? There are three different ways in which revenue could be recognized over time. And each of these, it's not, don't think this is cast in stone, right? But essentially they were meant to cover or catch very specific types of goods or services. So the first one speaks to a situation where the customer simultaneously receives and consumes the benefits that are provided by the entity's performance as the entity performs. So as the entity is fulfilling their promise, the customer is benefiting and consuming. So there's nothing left over. The example we say is security. So for example, you might have a security contract for a year. As the entity provides security on every single day, the entity provides the security. The customer receives the security service and they consume it. So it's not like there's this security service you provided today, I can use tomorrow. I receive it today and it gets consumed today. So the service you provided today is consumed today. I can't use this security service tomorrow. I'm consuming it fully today. You perform it, I receive it, I consume it as a customer now. As you perform, I receive, I consume. This was meant to cover your vanilla type of service agreements. Hear me very clearly, vanilla type of service. Not all service contracts. So not all service contracts will meet this criteria, but vanilla type, meaning security, maintenance, cleaning. So very straightforward, easy type of service contracts. If I'm cleaning, someone is cleaning your house, they provide them the service of cleaning. As they clean the bedroom is clean right now. You can't hold on to that cleaning, it's done. If they walk out of that bedroom and they've finished cleaning that bedroom and dust falls on, someone's going to re-clean that bedroom, right? So it's consumed as you receive it, it's consumed. That cleaning is done. If it gets dirty again, someone's going to provide a new service. So tomorrow's cleaning service is a new service. Received, consumed simultaneously. So very, very vanilla type services. The second one is where the entity's performance creates an asset that the customer controls as the asset is created or enhanced. This covers a lot of construction type contracts. But obviously not only construction type contracts, but that's a very good example that we all can kind of see. That we get into this contract, typically the customer owns the land. Then they hire somebody to come and build a house on the land. So as part of building the house, you have to lay the foundation, build the walls, add the windows, etc., etc. But with each step that you're performing, so as you lay the foundation, this foundation becomes essentially the property of the customer, right? So if the contractor or the entity as a contractor gets fired, it's not like the foundation you've laid can be taken back. As you've laid that foundation, it becomes the asset of the customer. So the customer obtains control of this foundation as you lay it, as when you're doing it, right? And it's enhancing the asset they already had. They already had the land, they already had property. You've added a foundation, so you're enhancing this property, enhancing the land that they already owned. Okay, so as you add the foundation, as you add the bricks, as you add the windows, what you're doing is adding to an asset that was already owned by the customer, enhancing this asset that the customer already owned, and you're transferring control because I mean it's on their land. So as you're putting stuff on someone else's land, it becomes theirs, right? You're transferring control as you go. Okay, so the construction type contracts are very good examples that would meet this criteria. Customer owns it, you're doing something that just enhances something that the customer already owns and controls, and you're transferring this control as you're going along. Okay? That's a typical type of contract in this world. And then the other type would be if the entity's performance does not create an asset with an alternative use, and the entity has an enforceable right to payment for performance completed to date. Or another way to say it, because I don't like too many negatives, is essentially to say that as you're performing, you're creating an asset without an alternative use, right? So you're creating an asset very specific to this entity, so it's to this customer. So you as the entity have no alternative use for this asset. And in addition to the fact that you've got no alternative use for the asset, you're entitled to payment for performance completed to date. This kind of tries to capture services that are or performance that's very entity specific. So we've got an example of an audit, but it could also be like when you're building a type of asset for the entity. So you've got a factory, we've got a plant, and you're building a very bespoke, very specialized kind of machine for a client. If this client was to cancel this contract, you've got no business, you've got nothing to do with this machine. Like there's nothing else you can do. It was made for them to their specification. It's very specialized. It's for them, right? So you as an entity have no alternative use for this asset. So that meets part one. You're creating your performance creates an asset where you don't have an alternative use. Then the last part, and it's an end, right? You've got an enforceable right to payment for performance completed to date. Meaning, if the entity cancelled, so you've worked 20% of the contract, the customer cancelled at 20%, you've got a right to payment. And that payment must cover at least your costs for what you've already, or the cost you've already incurred, plus a reasonable margin. A reasonable margin does not mean the exact margin you're going to earn upon completion, but it must be a margin in line with the other contracts or other contracts in this line of business. So typically, businesses wouldn't have a 25% standard profit margin. The margin might raise, let's say for this particular business, our profit margin is 20 to 30%. For this particular type of business, our margin is 15 to 30. Okay, so there might be a range of a margin. So when you're assessing whether you've got an enforceable right to payment for performance completed to date, it must be payment that will cover the costs as well as be within the range of the margins for that particular type of business and that particular type of customer. So it does not necessarily have to be the exact profit you're going to earn if you completed the contract, but it must be within that range, within this within this world, this level, I mean this sector, this customer, this type of asset you're creating. Okay, so if you meet either of these, you recognize that revenue over time. Okay, so if you've got a vanilla service and the customer simultaneously receives and consumes, you conclude over time, happy. If you create an asset, so you conclude over time, you don't continue with the other two. If it doesn't meet this, you come to the next one. If you land here, you conclude here, you don't come to this last one. If you don't meet this one or this one, you assess this one. And if you meet this one, you still conclude over time. If you don't, if it's no, then you conclude at a point in time. See? So at a point in time is always because it does not meet any of the overtime criteria. Okay. I said easier one, typically not too many marks here, but the key thing when you're assessing step 5 is start with this, start with the overtime. So start with 1, 2, 3, assess these 1, 2, 3. Then if you, and again, assess is 1, 2, 3, only if you meet 1, stop there. If you meet 2, stop there. If you meet 3, stop there. So 1, 2, 3, stop. If you meet 1, carry on, move to the next PO. For the next PO, if you meet 1, move to the next PO. And then go 1, 2, 3. If you meet none of them, then you conclude at a point in time. Right? If you meet none of these 3, it means revenue is not recognized over time. It's recognized at a point in time. And then the consideration there is at what point in time. Okay? And the point in time is the point when you transfer control. So when the entity transfers control to the customer. The standard then gives us examples of when we would see controls have transferred. So this could be if there's a right to payment, with legal title transfer, etc., etc. Customer significant risk and rewards. But the standard gives us these type of criteria to assess, to say, now this is the point in time. Okay, so first, is it over time? If not over time, it is then point in time. And the question becomes which point in time. So conclude points in time, then also conclude at which point in time. Okay, so let us step 5. Are there any questions there? Are we good? Are we still here? Thank you. Thank you. Okay. So step 5, that closes off recognition. 1, 2, 5, that's recognition. That's on IFRS 15. We then move to measurement. The first part of measurement is step 3, where we determine the transaction price. What are we doing? We're assessing how much we're going to get from this contract. So determine the transaction prices overall. How much am I going to get from this contract? Okay, how much am I entitled to recognize as revenue? Yes, Amukela?
Sorry, can you please just go to that step of overtime just a minute?
Okay. Amukela, you got unmute? Amukela, you unmute?
Yes, I'm muted. Yeah, you can move. I just wanted to say something.
Oh, I don't want to see the slide. Okay, cool.
Thank you.
Cool. All right. So the transaction price is essentially the amount of consideration which the entity expects to be entitled in exchange for transferring the promised goods or services. So the amount we expect to get for delivering our performance obligations. That's it. Okay. Few key things to consider when working out or determining the transaction price. There's a lot of detail in IFRS 15, and please do get familiar with it. But essentially, 4 key things to consider about determining the transaction price. Yes, Zintle?
Sorry to interrupt you there. I didn't want you to get into this before this. Why do we do it like this? Why do we start with step 1, 2, and then we jump into step 5, and then now going back to step 3? I think this is when, even when I answer IFRS, I just get lost, because most of the videos, there's always that inconsistency, like not like inconsistency, but the jumping on steps now. Like, please enlighten me on that.
Okay. The logic really is simply to discuss recognition together when we teach it, and then discuss measurement together when we teach it. That's the only reason we group 1, 2, and 5, and then group 3 and 4 together. But that please, 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 when you answer the question, still stick to 1. Go from 1 to 5 when you answer the questions. But it's just for us to group the different sections. That's all. That's all. Okay. And we don't mean to confuse you. I'm sorry. We're not trying to confuse you with that. Pamela?
Kanye, for me, I just wanted to say, it makes sense why the steps go as they go, like 1, 2, 3, and 4. Because thinking about it, even though you're trying to recognize something, you can't recognize until you have measured the amount. So that's how I make sense of it for myself, to say, okay, I go through step 1 and step 2, and then now after I meet all the recognition, I need to know how much am I going to recognize, then complete step 5.
100%, right? That's exactly why when we answer the questions, we need to follow the 5-step process, because exactly to your point, Pamela, you cannot recognize revenue until you actually know how much it is. So you won't, it's all good and well to know point in time, over time, but you won't know the value to put in the revenue, the value to put into the journal, until you've actually done step 3 and 4. Once you've done step 3 and 4, you actually don't know how much you're entitled to over on the contract as a whole, as well as how much I'm entitled to for each PO. So step 3 and 4, that's maybe how you should think about it. Well, I can't determine how much to determine to each PO until I know what the POs are. So step 2 must come first. After I know about the contract, I must do step 2, because then I must know how many performance obligations I've got. That will drive how I'm going to allocate it. Once I know how many POs I've got, work out how much I'm entitled to, and then allocate it to the performance obligations I've got. Then once I've allocated it, then only can I put something in my books. Then only can I go to step 5 and actually recognize the revenue in my books. Yes, Felicity.
Yes, can you hear me? Can you see?
I can, you're a bit faint, but I can hear you.
Okay. Let me try this.
Much better,
Yes.
much better.
Okay. Thank you. Sorry to just take you back. Just want to confirm something in terms of exam technique. Yeah. You're saying that in terms of performance obligations, it is satisfied over time. We go through those criteria, right? And then if it doesn't meet those criteria, then we conclude that it's satisfied certified at a point in time. Ne? And then do I just conclude there to say it's a point in time, or I then have to indicate which indicator in terms of paragraph 38 was it in terms of that list?
Good question. So after you've concluded at a point in time, you must then conclude what that point in time is. And to also conclude what that point in time is, it will be based on something in this list, right? So we'll be able to say it's at a point in time, it's at, let me think, you'll say maybe it's at a point in time, and the point in time occurs when the customer takes ownership of the goods, which is at the point of sale, right? So at the point that they take ownership at the till. Or you'll conclude it's when the contract or the house is signed off, I don't know, is signed off by the inspector, and that's a point in time. So you won't necessarily have to come and speak directly to one of them, right? You don't have to quote these, but you must highlight what the point in time is and explain why you perceive that to be when control transfers.
Oh, okay. That will be so. In terms of this requirement, it will be directed basically by the scenario.
Yes, it'll be directed by the scenario.
No, thank you.
Cool. Okay. So for determine the transaction price, very key. Transaction price, we're looking here, right? Look at contract level. How much am I entitled to from this contract? And there are lots of things that could happen. These are the 4 key things that could affect the amount you're entitled to. But as you'll see, for each of these 4 things, there are sub-considerations, okay? The standard has a lot of detail of this as well. They discuss it quite well, I think. I'm just going to try to say it in English so that it's easier to understand the IFRS. But essentially, 4 key things is there variable consideration? Is there significant financing component? Is there non-cash consideration that we're receiving? And is there consideration that I'm paying to a customer? 4 key things. So when you're looking, when the question starts talking about how much you're going to receive, these are the 4 key things you should be thinking about. Is there something that's causing variability? Is there a gap between delivering the goods or satisfying my performance obligation and payment? Is there part of the payment terms that requires the customer to pay me in something other than cash? So maybe they're going to give me 30% in cash and 70% in their own shares, or 30% in cash, 70% through an asset, right? So is there something that is going to result in a payment that is non-cash? And is there, or is there maybe some payment that I am making to a customer? So there will be a point in the question where they tell you what the payment terms are. They have to, right? Tell you if they got a testing measurement. They have to tell you what the terms are. Things that could cause variability, for example, there could be discounts, right? So I'm going to give a settlement discount if you pay within 30 days. So I'll give you a 2% discount if you pay within 30 days. Or there could be a bulk discount. If you buy more than 20 of a specific good, I'm going to give you a 5% discount. There could be a refund liability. So I'm going to say, I'm selling this to you today, but if within 30 days, this thing does not meet your expectations, that doesn't live up to your satisfaction, you can bring it back and I'll give you a refund, right? So that will affect how much I can recognize as revenue. It could be that if I finish this project within a specific period, I could get a bonus, right? So then my transaction price could be much higher. Or if I'm late, there could be a penalty. So my transaction price could be much lower. So variable consideration is broad. Don't try to limit it. It is broad. It is when they're telling you that your consideration could change. It could change because you're offering discounts, you're offering refunds, you may be entitled to a bonus, you may be exposed to a penalty. Read, when they speak about the payment terms, think about anything that is causing uncertainty to how much you're going to get. Okay? That uncertainty means you're going to have to estimate. You're going to have to estimate how much revenue you can recognize. Right? That's the thing about variable consideration. Just because you're not sure you're going to receive it doesn't mean you don't recognize anything. You have to make an estimate as to how much you think you're going to be entitled to based on your best experience, right? Your past experience with these similar type of contracts. For instance, if you're entitled, you may be entitled to a bonus if you finish in 6 months, but you know that typically these type of contracts take you 7 months. It's unlikely. It's unlikely you're going to be entitled to that, so you don't include that bonus in your transaction price, kind of thing, right? So you use the best information you have based on past experience, based on existing conditions to help you estimate how much you can recognize. Okay? So you make the estimate. However, you need to only recognize revenue to the extent that it's unlikely you'll reverse it. This is where this constraint comes in. Very key, they love testing this thing. It's a constraint on variable consideration. So key thing with variable consideration, you need to make an estimate, right? Estimate how much you're going to be entitled to. But you do not recognize any revenue if you think there's a significant chance of reversal. That's with the constraint. You're constrained to how much revenue you can recognize if you think you're going to reverse it. What would cause that? What would cause you to think you'll have a significant reversal? There's too much uncertainty. So maybe you actually don't have experience with this kind of contract. So you actually can't make an assessment of the likelihood of getting that bonus. You can't make an estimate that you're actually going to be able to achieve that 6 months. So then you can't recognize the bonus. It's not happening. You have to keep it out. Okay? That's the constraint. You do not have enough information to make that estimate. Constraint. Okay? These estimates will be revised every reporting period. So if maybe by the end of the first reporting period, you don't have enough information, it's not clear, you don't know, you hold back. You don't recognize anything. Oh, you don't recognize the bonus, any portion of the bonus payment. Then, by the next reporting period, it's becoming clear that actually I'm so much on time. Yes, you're on slide 33, which has the determine the transaction price. Yes, we are. Then by the next reporting period or by the next month, it becomes clear that I will make this. Then at that point, you can start to recognize the variable consideration. You can start to include the bonus payment in your transaction price once it's no longer uncertain. Camilla?
Oh no, old hand, sorry.
No worries, no worries. Okay. So variable consideration, key, many things could make it variable. So be on the lookout for things that indicate the transaction price is not fixed. Constrain. Constrain if you're not able to assess or be not certain, but almost certain that there won't be a significant reversal of revenue. So if there's a lot of uncertainty, constrain your variable consideration. Okay, so there's many different types of variable consideration. I won't go into all those details, but there will be one of them tested or discussed in the question. Significant financing component occurs whenever there's a difference. So you must always consider whether a significant financing component exists. If there's a difference in timing between when you satisfy a PO and payment is received. Even if it's maybe you satisfy the PO today, you receive part of the money today, you receive another part later. When there's that deferral, any difference in timing, always consider the existence of a significant financing component. Doesn't mean it exists, but always consider it. Okay, so first consider it is possible and note it, right? When I say consider, note that you're considering it. That there is a possibility of a significant financing component because there's a difference between when I satisfy the PO, which is here, which is on and when payment is received, which is Then you consider whether whether it meets the practical expedient. What's the practical expedient? That if the difference in timing is 12 months or less, we don't need to worry about significant financing component, right? So if there is a deferral, but it's fine. The deferral is less than 12 months. We're good. We keep it moving. Okay. Then we say it's fine. We've considered. So you discuss that you've considered it, but then you also discuss that, but the period is less than 12 months. Therefore, we'll utilize practical expedient, and there is no significant financing component to be considered. Keep it moving. Okay. Then you also, if you don't use a practical expedient, you also need to consider what causes the delay. So it's not a given that whenever there's a difference in timing between payment and satisfaction of POs, that there is a significant financing component. We need to understand why. Is it maybe because the customer was like, I'll pay you, but please hold it for me. Hold these goods for me because I actually don't have space. Because in that case, nobody's financing anyone. You are just keeping the goods on your premises because maybe the customer doesn't have space, as an example. So it's a customer's instruction. So in that case, it's not financing. And maybe that's where I should actually take a step back. The significant financing component, actually trying to assess whether there's something else in the transaction price. So it's trying to assess, am I getting, or is the entity getting paid for the goods they're delivering, as well as earning something else, like interest? Is the interest income? Or it's the interest expense, because maybe actually the customer's financing you as an entity. Maybe the reason you've got these funny payment terms is because we need the money as the entity upfront so that we can go and buy the goods and services to deliver to the customer. So the entity is actually the customer is actually financing you. So it's trying to assess if either of the parties are financing each other within this contract, so that there's a contract for goods and services, but there's also IFRS 9 element here because we're actually there's actual financing. So there's interest income, interest expense going on in this contract somewhere. That's what we're trying to assess here. And that's why we worry about the difference in timing and worry about what is the underlying cause. And also don't worry if it's less than 12 months, because typically the effect of discounting is immaterial if it's less than 12 months. Okay? Amogela?
Hi, Kenny. So the question that I have is, can I please just get clarity here? If there's a significant financing, basically we're trying to make sure that our transaction price will exclude that significant financing component, isn't it?
Basically. So it is a significant financing component. What you're going to do is split out what is the amount for the revenue. So that's the transaction price, the amount for IFRS 15, and what's the amount that's actually being financed. So the amount that's going to be recognized as interest income. So what we're going to do, yes, so exactly what you're saying. There's a financing component, we're going to discount, and that's going to be our transaction price.
Okay, so basically what we're trying to do, if now the customer would only be paying us later, we obviously have to check if the customer will be paying us post 1 year, because then the practical experience would not apply. And then if then that's the case, we'll just have to present value to this amount as to how much revenue can we recognize today, right?
100%.
In the scenario now that you're speaking about, now that the entity is saying that it wants to receive money upfront before it can deliver to the customer. In that instance, obviously, if we're only going to deliver to the customer after a year, there's a significant financing component. And then there's a possibility that the entity might be paying an interest expense to the customer. So what we're going to say now is that there won't be any recognition of revenue. I want to understand this part because we hadn't delivered as the entity, right? But we're only going to deliver to the customer post what is this? Post a year, and then the significant financing will be applying. So what happens to this interest expense that the entity has incurred throughout the entire year of producing that particular thing? Is it going to be reduced from the total cost of revenue when we now going to deliver to the customer?
Yeah. This Amogela needs, yeah, I'm not even going to try to explain it in words. This actually needs an Excel and a calculation to show you. But yeah, essentially we're going to have the amount, when we receive the amount in the bank, we're going to earn interest income. We're going to be charged or charge ourselves interest expense over it because it's actually a component of it. And then there will be a split between, I'm just trying to think if it's going to add or deduct, but there will be a split between what is the actual transaction price and what is the interest expense. This, I will try to find an example to work through because trying to explain it in words, I think will just confuse everyone.
Okay. Okay.
Okay. Cool. Sorry, I'm just noting that. Okay. Is it clear?
No, it's not a question, but to say, please, ma'am, when you are explaining Amogele's example, can it be in the class for me? Because honestly, I also would like to see that you actually to benefit everyone. Yes.
Yeah, I don't think I'll do it in the class. I think I'll try to share something in Viva Engage because we definitely will not have time. I think we're already going to run over time today, so we definitely won't have time to do that. But I'll try to share it as part of the materials, and then we can work through it. And I mean, I'll share it, and then I'll also add comments into whatever I find, so I can try to talk through it, to make it easy. Cool. Okay, so those two is what typically gets tested quite a lot. The variable consideration and the significant financing component is a big part of what gets tested. Other parts, easier, I think, to understand, is non-cash consideration. So in this case, that's if you, as the entity, will receive cash, maybe, but also something else. So you're transferring a good to a customer, so you're selling water bottles, but the full amount won't be just cash. The entity might pay you in their own shares, as an example. In that case, you recognize your revenue at the fair value of the consideration you're receiving. So the fair value of the shares on the date that you transfer control. So if it's at a point in time, at the date you transfer that control, you recognize the revenue at the fair value of those shares. What you'll do is you'll create revenue based on the fair value of those shares, and you'll debit a financial asset of shares. After that date, those shares are now a financial asset owned by the entity, and the entity continues to account for those financial assets in terms of IFRS 9. So you'll continue to treat them at fair value or whatever else. But the only thing relevant for IFRS 15, is at the date you receive the non-cash consideration, you recognize revenue at the at the date you transfer control, recognize the fair value of that non-cash consideration. Afterwards, you deal with it in terms of whatever other standard is applicable. So it could be shares, it could be another asset they're giving to you. Whatever the non-cash is, recognize at fair value on the date you transfer control. Thereafter, you treat it according to the other relevant standard. If it's property, in terms of investment property. Shares, in terms of IFRS 9. If it's an item of PPE, in terms of IAS 16. So day one, bring in the revenue fair value. Subsequently, treat whatever non-cash item you've received in terms of the relevant standard. And then consideration payable to a customer. It doesn't happen too often, but it would be in a situation where you've got a contract, and obviously, typically, the customer is paying the entity. You're delivering goods, the customer pays you. But in some contracts, like a lot in the FMCG space, you could, as an entity, be selling, let's say your Kellogg's, you sell your goods to ShopRite. ShopRite pays you, obviously, for these goods, but also ShopRite could be charging you a certain amount because there's certain prices you pay for goods being at eye level, goods being at this level, whatever. So for your goods to be at a certain shelf level in their store, they could be charging you an amount, right? So you can have a consideration that you are paying to your customer, to ShopRite. So they are paying you to buy your goods. You are paying them a certain amount as well. This is where we need to assess. Are you paying for a distinct good or service, or is it a reduction of the transaction price? So we go to, why are you making this payment? The question becomes, as a result of this payment, do you receive as the entity distinct goods or services? Okay, so I'm making a payment to ShopRite, and in return, am I getting something? Okay, am I getting something that's distinct, whether it's a good or service? And if so, that amount I'm paying will then be treated separately, and it will be an expense, right? Like a marketing expense. So I'll treat it separately. It doesn't affect my transaction price. My transaction price with ShopRite, between ShopRite and Kellogg's, will still be based on however much I've charged them for my Kellogg's. Then this amount I'm paying for my advertising at a certain level will be a separate expense I'm dealing with. If, however, I'm not getting a distinct good or service, the amount I am paying to the customer will then be a reduction of whatever Kellogg's, ShopRite and Kellogg's have agreed. So as Kellogg's, whatever amount I've charged to ShopRite, the amount that I am paying to them, I will deduct from my transaction price if I don't receive distinct goods or services. And that's a really key principle. I mean, there's lots of detail, and we're going to cover some of it when we go through the question, but that's the key thing. Is there some variability? Should I constrain? Is there a difference between payment and delivery of goods and services? So is a practical expedient applicable? What is the reason for the difference? Am I receiving payment on something other than cash? Measured fair value. Am I paying something to a customer? Why am I paying it? Am I receiving goods or services in exchange, in return? If so, treat that separately. If not, reduce my transaction price. Okay? That's high level. Very high level, the key things to worry about, not worry about, but consider when you're asked to think about the transaction price or determine the transaction price in a contract. Any questions? Okay. Then step 4. Step 4 is really, I mean, I'll talk to it now, but it's really much better understood in an actual calculation. It's much better to understand what we are saying here. But essentially, once we know what the transaction price for the whole contract is, we need to take that amount and then determine how much is applicable to each PO. So you see, step 4 brings step 2 and 3 together, right? In step 2, we determined what our POs are. Step 3, we determined how much we're entitled to for the whole contract. In step 4, we take the amount we're entitled to and we split it between the POs. Okay, so it brings the two together. Back to that concept of a standalone selling price. All right, so our location, let's say we've got 3 POs in the contract. We will need to allocate the transaction price to each of the 3 POs based on the relative standalone selling price. Meaning we need to determine the relative standalone selling price of each of the POs. Okay, and what do you say the standalone selling price was? We said it's the amount that the entity typically sells the different products and other contracts, right? So it's the amount they typically are happy to sell this for. It's typically the selling price. That's the easiest. The selling price, and it's only one price. Easy. That's the standalone selling price. However, if it's not clear what the standalone selling price is, there are ways we can estimate it. So we can estimate it based on what our competitors sell the similar stuff for. If we can't determine this, we can use expected cost plus margin. So how much we think that's going to cost us to make the products, and what's the margin we typically want to earn? What's the margin we earn on these type of goods? And if we can't use either of these two, then it's the residual approach. Okay. So if in our contract we've got 3 POs, we can only use a residual approach for 1. So this would only be used if you typically have this good and you sell at different prices and lots of different prices. So it's very hard to estimate one standalone selling price because sometimes it's 5 Rand, sometimes it's 20, sometimes it's 30, sometimes 15. So it's all over the place, right? So it's a broad range. Or you don't have an actual price listing yet. So then we use a residual. We don't like the residual approach. We don't, as a standard, it's not our favorite approach. We don't like residual approach. We only use it if we can't. If there is no observable price, we can't see the competitor's pricing. And for some reason, we can't determine the expected cost plus margin. Okay, then we use a residual. The residual approach basically says, okay, the total transaction price is 100. I've got 3 POs. I am able to work out the POs for obligation 1, for PO2, then the residual will be what is then left for C, because I can't work it out. So we don't like it because it's not really based on the actual good itself. It's just it's an approach we use because we've got no other option. So I don't like it. I don't focus on it too much. What we want, if there's an observable price, yes. If we don't have an observable price but a competitor's price, yes. If we don't have either of those two, then expected cost plus margin. And that's the order of preference. Observable price, adjusted market, expected cost plus margin, or residual. Okay. Don't want to talk too much about this because again, I think this is something that is much better understood and if we actually work through the question. If we try to talk it in words, it's not so clear. But maybe just the thinking. The thinking is that the total transaction price is to compensate the entity for all the goods and services they're providing. There is nothing that we as an entity want to provide for free. Actually, everything that we are providing to a customer, we want to be compensated for it. And if we come and group different goods or services together, what we will try to do and probably successfully do in most cases, is ensure that the price at which we sell these three items together compensates us for, or at least to an extent, for each of the goods provided, right? Based on how much we'd sell them for separately, right? We need to ensure that we're still making some kind of profit, even when we bundle these things based on how much we sell them for separately. If we put a discount on the bundle, this discount typically does not relate to only one good or service. It typically relates to the bundle together. So even if you say we're giving you a discount on product 3, chances are this discount is actually just a way to get you to buy all of them. Because again, we don't want to make losses. We want to recover our cost plus some kind of margin on every single one of the goods we sell. So if you've got a discount, we're also going to allocate, very similar to this, we're also going to allocate the discount across all the POs in the contract. We'll allocate that also based on the relative standalone selling prices. But we'll see how we do that when we work through the question on Printco. That is the theory, quite a bit of theory. Apologies, I did not expect us to take this long on the theory. Let's take another short break, 9 minutes, and be back at 12:30 to start working through the question.